Imagine this, you're up 200 bucks on a trade, head to the kitchen for a coffee, and when you return, it's down 400. Suddenly, your laptop feels like the enemy. Sound familiar? You're definitely not alone. A staggering number of retail accounts fell, not because their entries are bad, but because no one ever taught them a professional strategy for how to exit. Today, I'm sharing the exact checklist that I use to manage a trade from start to finish. No jargon, no gurus, just simple rules that fit on a sticky note and help save your account. While most videos start with candlestick charts, let's kick off with the truth. A stop loss isn't just a safety net, it's a business expense that defines your trade idea. Think of it as a cost of finding out you're wrong. If you can't point to the exact technical level on a chart that proves your trade idea is invalid, you're not trading, you're just hoping. Write that down on a sticky note too. Before you hit that buy button, ask yourself 3 quick questions. 1. What dollar amount am I emotionally comfortable with losing on this single trade? 2. Does that amount put my account in jeopardy? And 3. At any given time, am I risking more than 50% of my total account balance across all trades? Now, 50% might not be a percentage that you're comfortable with. You have to find that percentage. If the number makes you nervous, lower it until it feels boring. Boring is good. Boring helps you keep trading next month. Next, I want you to pick your method. I use technical levels. There's one way for me to set an exit price, and that is based on a technical level. Before entering, I identify the key buy zone or sell zone. My stop loss is placed at the bottom of a buy zone for a long trade or the top of a sell zone for a short trade. But here's the critical part. Don't get stopped out just because a price wick touches your level. It must be a full candle body closing past your stop on the time frame you're trading. This single rule prevents you from getting shaken out by noise. Now let's decode some different stop order types. A fixed stop is your line in the sand. It is based on that technical level you've chosen. A trailing stop automatically moves your stop up as the trade goes in your favor. And a stop limit order will only fill at your exact price, which can be risky in a fast-moving market. And don't forget the unsung hero, a time-based stop. If your option is just 2 to 5 days from expiration and the momentum has completely died out, it's time to leave the party with your chips. It's often better to exit based on time than to let data burn your capital to zero. Another important part of managing risk is position size. My position size is based on that amount that I am emotionally comfortable with going to zero if the trade, for unforeseen reasons, works completely against me. Once I know that amount, then I'm going to know my position size. So let's say that amount is $500. Looking at this example on SPY, I have 2 entries. I want to use 1/2 of the allocation, or $250, to enter at the top of my buy zone. So you can see I would be able to afford 1 contract at $250 allocation. Then, if price continues to drop and makes it to my second entry, I'm going to use the remainder of my total allocation to purchase as many contracts as I can without going over that total allocation. In this case, it would probably be 2 to 3 contracts. Now I am appropriately position sized. Your trade management plan should be automatic, but you still need to check in. For options, this is crucial as you get closer to expiration. Set a calendar reminder. If a trade is within 2 to 5 days of expiring, you must ask one question: does this trade still have momentum? If the answer is no and the price has stalled, it's often best to close the position and protect your capital from rapidly accelerating time decay. Let's talk about risk to reward. It's not a ratio, it's a filter for me. If you are risking 50 bucks to make less than 50 bucks, you need to be right more than 51% of the time just to break even. But if you make sure that your risk to reward is at least greater than 1 to 1, you only need to be right about a third of the time to be profitable. That is why you need to make sure for any trade that the risk to reward is at least 1 to 1. And honestly, I prefer a risk to reward of 1 to 2 to really be a good looking trade. Casinos stay in business because they understand the math. Now you do too. Skip any setup that offers less than a 1 to 1 reward. Your future self will appreciate it. Will you do me a favor? Take 2 seconds, hit the subscribe button and ring the bell. That way this video gets pushed out to other traders that are struggling with managing risk. Now let's talk about some common mistakes that can punch you in the face. Don't move your stop against you because the trade is not working or because you think it'll come back. The market hates that. Another classic mistake is getting stopped out by a quick price wick. If your rule is to wait for a candle close, stick to it. Letting a quick stab of volatility scare you out of a good trade plan is a rookie error. Set your stop level, define the conditions for exit, and let the market prove your trade idea right or wrong. Want to know why we commonly make those mistakes? It's about trade psychology. You're not afraid of losing money. You're afraid of being wrong. Once you separate your net worth from your ego, stops turn into receipts, not report cards. Now I'm going to share my exact process of how to keep a winning trade a winner and not let it turn into a loser. In the first chart, after price has made it to my first target, I move my stop from the bottom of my buy zone to my entry level. Then, as price comes into my second target, I now am going to draw Fibonacci's from the bottom of my buy zone to the current price. Once I have done that, I locate the 38.2 fib level, and that is now my new stop. Now we're really in a good trade. Price is moving up and has hit my third target. What do? I would be tempted just to exit right here, but we haven't made it to final target. Instead, I want to continue moving my Fibonacci retracement tool up to the current price and move my stop up with it as that 38.2 continues to climb. Then the important part. We've made it to final target. You have 2 choices here. Number 1, take your money and run. Or number 2, if there is still a lot of momentum behind the trade, I like to place a trailing stop. I use a 10% of the option premium value at that final target as my trail stop. So if the option premium value is $5, I would set my trailing stop as 50 cents. Good job, great profits, and you followed your plan. All right, let's recap my exact process and write these down on a sticky note. Place them on your computer so you see it every day. Got your emotional risk amount written down? Check. Identified the technical zone and stop level? Check. Sized your position using the math? Check. Set an alert for a candle close, not a wick? Check. Defined your target levels for moving the stops? Check. Have a plan for time decay near expiration? Check. Now you can lose the right way, and losing the right way is just the cost of doing business. Next time you feel that coffee break panic, you won't freeze. You'll glance at that sticky note, remember your plan, and let your strategy do its job. Master this process, and you won't need to chase home run trades. You'll keep hitting consistent singles and doubles while everyone else swings for the fences and strikes out. Hit subscribe. Grab that sticky note, and I'll see you in the next video where we turn this strategy into a retirement account that can fund your coffee breaks. If you're not already a part of the Trendy Trading Room or SPX Room at Simpler Trading, check the link below where you can join my trading partner John and myself every day as we trade and educate live. I look forward to seeing you in the next video.